Hello. Hello, everyone. Hi. Good morning.
Good morning.
Okay. Sorry, I'm a couple minutes late. My computer was dead. Had to reboot. All right. So, want to jump into the problems? We got an hour, so I want to make sure we use our time. Anybody have any comments or questions before we start? Okay. All right. Well, so what I was thinking, because I went over these last night, is I'm going to share my screen, and I'm going to pull up my my Excel spreadsheet that I was working on, and so you guys are going to be able to see my file that I'm working on. Okay. So let me go ahead and do that and make sure that you guys have a good view to this. So I'm going to do a share, and let's just make sure. Okay, can you guys see the Excel spreadsheet that I have here?
Yes.
Can everyone see it okay? All right, great. I'm going to make it just a little bigger if I can. So, a little bigger. There we go. Okay. So the way that I think I'm gonna do this is I'm going to pull up the problems one at a time, and I want to actually work through them with you because I don't want to just do them for you. I really want to hear your thoughts, how you've done them, and we'll make it collaborative, right? And then just you guys, I want you to answer them, okay, versus me just answering them. Because I know that wouldn't really help your learning, right? And so I think I'm going to start with this one. And what I did, this is the first one. So this is really just the reorder question, okay? The reorder problem, I should say. And what I did, originally I just put different values here because I wanted to just focus on the ordering and not so much the answer. But why don't we start with that? Because I know, I don't know if anyone had a lot of questions about this, but one of the things that was challenging in the book is that the answer was incorrect. They had a final expense number that was 460, and that number is wrong. So obviously that, sorry, go ahead. Jenny, did you have a question? Oh.
I thought it was still four. You mean after we add them and then we get 460?
It's not 460. Yeah, right. So we could actually look at, but before we do, why don't we go through and just make sure that we're all understanding how to order, okay? And we don't have to necessarily focus on the numbers, but we'll look at that in a minute. But so here's a similar problem, I guess you'd say, with the same categories. So why don't we start with the revenue, because that's obviously the first thing we want to order. Can somebody walk us through what items here are revenue?
So the patient service revenue.
Okay, that's kind of like the first thing, right? So let's go ahead and put that over here. Okay, that's the first, right? Okay, and then what would come after that?
The provision of bad debts.
Provision of bad debt. Okay. And what I put here is I put that it was 10%, because often you'll see bad debt as a percentage of the total. So anyone just want to clarify how we would do that? If it was a 10% provision of bad debt, how would we actually calculate that?
Multiply by that 50 or 500K.
Times 10%, right? Okay. Pretty easy, right? Okay, so I'm going to go ahead and do that, and I'm going to just replace it. Let's do, just do 50,000. Now, is that an add or a subtract?
It's a subtract, right?
Subtract, right? Does everyone understand that? Does everyone understand the concept of provision for bad debt? It's okay if you don't. Just ask.
Can you clarify that? What
Can you explain it?
Yeah. So in companies, often like you may sell a certain amount, right? You might have a revenue or a sales number of X, so a certain amount of transactions. And what happens is you're giving credit to the folks that are buying your goods, right, or your services. So you'll invoice them, right? And then you wait for a certain period of time for them to pay you. Well, what invariably happens is there's a percentage of those goods or sales where the folks that are buying them, for whatever reason, don't pay you. They go bankrupt. They're just, disputing something, whatever it is, right? They don't actually pay you. They're, out of business. So often a company will do is we'll just take a certain percentage of their sales and say, we know that some portion of this won't get paid, right? And
Is that the same
we
concept?
have that situation. We're a $30 million company, and we have a bad debt of about $150,000. So it's not very big, but there's always some amount that don't pay you, right? So it's good to have a plan for that up front, and just go ahead and make that assumption. So that's what it is. It's like it's prudency, right?
Is it the same thing for returns, like in retail, or?
Yeah, exactly. So in retail, you'll often see that as well. You'll see there's a gross revenue, they call it, and then there's a net revenue. And the net revenue is net of, all those kinds of things that happen, whether it's bad debt, returns, different things that happen like that, right? Could be fraud, could be, things like that, right? So that's what that is, okay? And this is a high percentage. 10% is a really high percentage. I'm just using it as an example. It would most likely be less than that, okay? And then, so then what you do is you just net it, right? So you're saying you got your revenue less your bad debts, people that aren't going to pay, right? So that's what your net then is, right? Your net provision. Sorry, it's not provision. Put that on the wrong one. This is your net patient receivable, right? Net patient services. All right. So that everyone get that? Yeah, everyone get that?
So would it be helpful, I guess, for future reference to understand the idea of net? Is that the revenue minus whatever, like taxes or
Yeah, net just means there's a gross and there's a something else, that's offsetting, and then the net is the final number. Exactly. So you hear that number a lot in financial statements, is the net, right? So it's the number after, essentially, is what it is, right? Okay. All the deductions, after all the deductions. All right. Okay, so then what other revenue? Anything else that goes into revenue? Maybe that would be easier. I don't know. Like maybe we could categorize each one of these. Why don't we start with depreciation expense? What do folks think that is? Expense or revenue?
Expense.
Pretty easy, right? Because it's already said. But we know depreciation. We talked about that before, right? What depreciation is, and we'll go into a couple examples about depreciation later. But that's obviously an expense. Okay. General and administrative.
Expense.
Okay. Interest expense. That's easy, right? Now, interestingly, interest can actually be a revenue as well. So if you actually have money in a CD or a bank account, you could be earning interest. So it's very possible to see interest as a revenue also sometimes. Okay. Investment income.
revenue?
This is tricky, actually, because there's that word income, right? Income is different than revenue. And so income is more around sort of after you net expenses out of it. So there's revenue, there's expense, and then there's income or profit. And profit and income do get used interchangeably, so that can be confusing sometimes, but just remember profit equals income, right? They're basically synonymous. Okay. Okay. So in this case, investment income is really sort of at the bottom of your profit and loss statement. It's down here. So we're just going to call it income. Okay. And then net income, of course, is at the very end. That's the net income at the bottom. That's what you're always going for at the end, right? Okay. And here's other revenue. What would that be?
Revenue.
Yep.
Revenue.
Revenue. Okay, so let's put that, since we're doing revenue, let's go ahead and put that over here now. Revenue. Okay. So then in order to get the net operating profit, which is what we're looking for here, what do we do? What do we have to do?
Subtract.
Subtract what?
450 by 50.
Can we
Okay.
subtract it?
Oh,
Other revenue, is it a subtraction or is it an addition to revenue?
Addition.
Anybody?
I think Jesse said to add it.
Add it? Yep. Right, it's adding it, right? Because it's additional revenue. And so just so we're clear, what that means is when we have revenue, what we want to do, actually, I'm getting books confused here. That's not, I'm putting things in the wrong place. Sorry about that. That's net operating profit. I realized not net revenue. So I'm just confusing you all now, aren't I? Let's call this, because I don't think I have it listed here, but let's call it operating revenue. Okay, this is what we just calculated. Operating revenue. Okay, so yeah, the revenue can be from patient services, or it could be from some other line. Let's say you have a cafeteria at your hospital, and you generate revenue, right? So that there could be other types of revenue that you're including on your P&L besides your main revenue. And this obviously, in this case, would be the main revenue, patient services, right? So anything else can go there, and that's an add. So there you go. There's your operating revenue, okay? And now let's just go ahead and put the expenses in here. So what do we put in here first? We have a few expenses. We didn't go down here yet, but the purchase clinic services, would that be expense?
Yes.
Yes.
And salaries and benefits expense?
Yes.
Yeah, okay. So let's go ahead and put these in. Usually salary and benefits are first. When we're talking about expense, we usually put that as a first expense. So we'll put that there. And then usually general and administrative come next.
When we organize it, do we order by the largest amount first then?
No. Usually the order is, the classes, right? So often salary comes first. Not always, but often that is the case, right? And I don't know that there's a right and wrong answer here, but I think it's really you want to put your expenses in a block together, really. And with revenue, it's usually your key revenues are first, and then anything additional, like sometimes there may be transportation or food service or whatever it is, it would go second. Yeah. So salaries, benefits, general administrative. We've got purchased clinic, right? Purchase clinic services, which is next. We'll put that next. And then we have, what's next? Maybe we'll do depreciation, right? That often comes a little bit further down. And then we have, in this case, we have interest expense, right? That's an expense also, right? Okay, so we're gonna put those in. And does anyone, any questions on any of those? I think it's pretty straightforward, but I just want to make sure if you have a question, please ask. Because honestly, if you have a question, somebody else likely has a question as well. That's pretty, you guys, it's pretty self-explanatory, right? So you're just going to add it up, right? You're going to add it up. So there's your total expense, right? 630 in this example. And then how would we calculate the net operating profit?
You have the operating revenue minus the total of expenses.
Yep, right. Take your revenue minus your expenses, okay? Your net operating, well, in this case, it's a loss, right? This example I did, it's a loss, but that's kind of how it works. Okay. And then we have what couple other things here that we didn't put in yet, right? We didn't put in our investment income, right? That was one of the items. So that's going to go below, right? It's going to show up down below investment income. So it's below your operating profit. And so just to quickly explain that, the word operating means your operations. So let's say you're a hospital. And for normal operations include caring for patients. You might have a cafeteria, you know, but what your main operation that you do, like it wouldn't include any investment income. So what that means is if you have excess cash and you put that cash in the bank, or you buy a CD with that extra cash and you earn revenue or you earn income off of it, that is not dependent on your daily operations, right? It's not dependent on how many patients you see or how many people you serve in your cafeteria. It's independent of that. So from a P&L perspective, what we like to do is we like to show that as a non-operating item. That's why we split the P&L, the income statement, into operating and non-operating. And why that's important is because when investors look at your profit and loss statement or your income statement, they're going to try to understand how much operating profit you generate on an annual basis, right? They want to understand how profitable your business is. Yeah, it's nice to see that you're investing your extra cash and making money on security, which is smart. It's great that you're doing that, but that's not what they're really looking for. They're looking to see how well your operations are, okay? So that's why we segregate that. Does that make sense? Everybody get that? Okay. All right, and so then you got, what's left is your net income, right? And so net income would just be adding, in this case, it's adding your profit, your loss, and your investment income together. So you have a net loss of 50,000 in this example, right? So any questions on the actual book, the book example? Because I have it here. The way that it's ordered in the book is we had, the revenues here, right? The patient services were 440 less provision for bad debt. Then we had new patient services, that's subtracting them, right? Other revenues, there's your 410. And we put in all our, let me just get rid of this for a sec here, so it's not confusing. Okay, so we have all of our expenses that we talked about here, right? And so you can see that they add up to 420. The book had that at 460, and so that was just wrong. Okay, and then you have an operating loss, in this case of 10. You're adding your investment income, so you're getting to a net income of 30, right? So yeah, I don't know why. The only thing I can think about is why the book had 460 is that it's possible that they were originally going to add the provision for bad debt as expense. Sometimes if it, you will see it in expense. It depending on if it's actual losses versus a provision. So that maybe that's all I can think about. I don't know why else they would have made this mistake. Okay, so let's move on. All right, but you guys, if you do have a question, please speak up though. Okay, just ask the question. Was that pretty easy? Does everyone sort of get that? Give me a thumbs up if you get it. If it's easy. Okay, right. All right, Alexandra, Mina, Jennifer, any questions?
No, thank you.
No, we're good so far.
Okay, you guys got it. I can't see you guys, so I just want to make sure. Okay, great. All right, let's move on to the next problem then. Hello. Okay, so this one was, it's an insurance co, right? Let's see. Called best care HMO. All right. And so what they're asking is, how does this income statement differ from the previous income statement? Okay. And why don't you guys just give me some reasons that you can see why it differs? Just go ahead and call them out. Do you want me to pull this one in just so we can look at it? Let me just go ahead and bring it into this page so we can see it here. Okay. Kind of hard to see it. Maybe I'll do it this way. I'll do it this way. Does everybody like Excel?
Yes.
Yeah.
Anybody not like Excel? It's one of the best things ever invented, I think. Okay. All right, here we go. Here's the prior, here's the current. So yeah, give us some ideas of some differences. Let's go ahead and speak up.
It looks like they bulked the investment or other income with the revenue.
Say it one more time.
It looks like they bulked the interest and other income with the revenue for the operating revenue.
That's right. It's classified differently, isn't it?
Mm-hmm.
That's right. Is that confusing?
It wasn't confusing once, I guess, like, you have to factor in that it's two different types of businesses.
Yes.
So their statements will look different.
That's exactly right. That's exactly right. So good catch. So yeah, we've got this difference where investment in, and interest. Well, here interest is shown as an expense, but here interest is shown as income or revenue, right? And so I think a lot of this has to do with, again, how they classify their different line items. But obviously, if it's an expense, it's not going to show up as revenue. It would show up as expense, and they do have that here, by the way. You see that, right? They have the interest and other income down here as well, right? So they've got it in both places, don't they? Which is even probably more confusing. But what it just means is that they've got some that's positive and some that's negative. Okay. So like I said, you can have an interest income if you have a CD and you're generating interest, or you could have an interest expense if you have a loan and you have to pay interest, right? So it can go either way. So you just have to know whether it's some income or expense, right? And this actually is not called other income. Sorry, I know that's confusing. It's just interest. Okay.
And for the problems or the midterm, are we supposed to do percentage? Because I see that you have 7.3% and 4.3% respectively. So I just want to be clear if that's something that we're supposed to do.
So that's a different problem that we do that on, and so I'll you don't have to worry about that right now. It's only if you're asked to do that. Okay.
Okay.
It's I think as you get more fluent in financial statements, it's always good to understand what the profit margin is. I've been working for 30 years, and that's usually the first place I look to kind of give myself an idea: is this a profitable business or not? Right? But I think right now that's not necessarily what the problem's asking you to do in this particular problem. Right? I think it's coming later though. Right. So, okay. All right. Good question though. So what other differences do you see here?
So they don't have provision for bad debt.
They don't have a provision for bad debt. Mm-hmm. And that's kind of interesting, isn't it? But I don't think we need to go into a tremendous amount of detail, but like Jennifer had said, these are different businesses. So in an insurance business, you get premiums kind of up front, right? Right. So it's probably not as subject to bad debt as some other types of businesses would be. Yeah. Okay. Anything else pop out at you? There may be some differences in what shows up in the expense, right? So there's this insurance line, that's something different, right? We don't see that over here, although it's very possible that this type of expense does occur in this, and maybe it's just sitting in the general and administrative, right? So again, it just depends on how companies classify their expenses. Some bundle them in a big line like this, general administrative, and some call them out. And so really a lot of that just simply has to do with, there's usually reasons for that on how things are classified. They might be classified differently. And it's really just, it's about how maybe their investors look at it, how they're managing their lines of business, they're managing their expenses. It could be lots of different reasons. And often they'll change over time too. Like, so, you know, you will see the categories change sometimes in businesses. They may show something they didn't show before, right? So that's not a tremendously big deal, but it's just important. It's more important for you to understand what kinds of things go in expense and what kinds of things go in revenue versus memorizing an order or a type, right? Okay. And then there's one other difference that I see here that I don't know if anyone else wants to call out, but let me just do it. Is this P&L or profit statement is in dollars. So you know that it's $440,000 is like, for instance, the revenue. Here, what is this profit? What is this number actually? The 26,682. Is that 26,000 or is it some other number?
It's 26 million.
It's 26 million, right? So as you get larger as an organization, you start representing your numbers rounded to the nearest thousand. And when they're really big financial statements like the Fortune 500, you see them in millions. You'll see a number of 26 is what you'll see. So sometimes you have to be very careful and watch for that, right? If this is in hundreds of thousands, then the profit they're making is $1.2 million, right? Okay, so important to look at that. All right, and then let's go to depreciation. So they're asking about depreciation here. And the question was, is $367,000 actually how much money they spent on the fixed asset in the year? Or does it represent something else? So who wants to kind of clarify how to think about depreciation?
It just represents the eroding value of a material good, right?
It does. And how, so is there a,
There's a formula.
you can, oh, go ahead. Somebody else was going to say something else? So what I did is I just did an example over here, okay? Kind of a hypothetical example because I don't really know what this is. So what I said is, well, let's just assume that the 367,000 represents the annual depreciation charge, okay? Because that's how much we see in our income statement. So we know that 367,000 is the annual depreciation. So that would mean that other years are going to be 367,000 as well, right? So what I did is I just said, well, here's a hypothetical example. Let's say that we purchased, some very large piece of equipment for $1.835 million, okay? And let's say that piece of equipment, the useful life was 5 years, okay? 5 years. So that means we take the original purchase price of $1,835,000 and we divide it by 5, right? Because it's for 5 years. So we create those 5 years. Here's our 5 years. And every year, we're going to take $367,000 of that asset price, and we're going to put it on our P&L as expense, okay? So that means the remaining value over here is going to be the original purchase price less the depreciation. And then that gives you the remaining value. That's what you were talking about, right, Jesse? The remaining value. And then the next year, here's year 2. So in year 2, you're going to take the value from the previous year, which was $1,468,000, and you're going to take another $367,000 out of it, right? So then here we got the third year, we've got $734,000 left, right? And again, we're going to take the 367. Now, here we are in year 4. All we have left is 367 on our balance sheet. This is our balance sheet. And then you depreciate that last bit in that 5th year, and you've got no asset value left, okay? Because you've completely depreciated it, okay, across those 5 years. So what you're seeing in your P&L is just a portion, right, of that value that's being sort of depreciated every year, okay? So does this make sense? I just wanted to give you a concrete example of how this could work. Now let me just take a pause. Does everyone get that?
But sorry, for this, we would be using the example on page 98 of the formula, right? Annual depreciation expense equals initial cost minus salvage value divided by useful life.
Yeah, so in this case, we didn't know. I mean, I'm just saying this is a hypothetical situation. So I didn't put a salvage value. But yes, if there was a salvage value, then, so we could actually say, we could even, make that example if you like, because we could say that maybe there was a salvage value of 500,000, right? And so then maybe the actual price was 1,885,000, but then we reduced the salvage value to get the net, right? Yeah, that's right. Often there isn't a salvage value, right? Often you don't know that. But if you did, that's how you would do it, okay?
Just to try to apply it to real life. So is this something how like companies value computers, and then let's say at 5 years, the computer is still working? Would they just wait to purchase a new computer, or like how would we apply depreciation to a real life scenario?
Yeah, no, that's a really good question. That's a really good question. And I deal with that a lot. So, my IT person's always coming to me saying, hey, I need to buy a new server. I need to buy a new, I need to buy a new laptop. I need to buy, X, Y, and Z. And I always say, can we wait another year? Just one more year. Let's see if we can, let's push that useful life out as far as we can. Because what happens is, in my situation, I don't have to take any more depreciation on it. It's already been fully depreciated on my P&L. So I get a free year, essentially, right? It's kind of like with the new car, like with the car. I don't know if you guys all have cars, but like my car is fully paid for, and it's just about to break down. So I'm like, hey, as long as I can drive that car, I don't have to buy a new car. I might have to pay some maintenance on it, but I don't have to buy a new one. So I'm going to drive it till it dies, right? Because, if I buy a new car, then I'm going to have a car payment that I'm going to have to make every month. Right now I've got a free zone. I don't have to pay for a car in terms of a car payment, and I'm still driving my old car. So it's kind of the same thing. If you can, useful life is a guess, right? We all assume that computers are going to last for 4 years or 5 years or however long your organization uses to depreciate them. It's possible they could go longer though, and lots of times they do, or sometimes they go shorter. And then you have to retire an asset, but it's not depreciated yet, so you have to expense that, right? So, okay.
I'm still kind of confused about what it means. What does it mean to have fixed assets? If we were to go back to the question, what does it mean to try to look for a fixed asset during that fiscal year?
A fixed asset is just a term that we use for capital. It could be a land, it could be equipment, it could be automobiles. That's really just or buildings, right? So that's what in a financial statement and a balance sheet we refer to as a fixed asset. It's just a term, yeah. So in this case, whatever that equipment, I'm just using this example, this equipment purchase was the fixed asset that we bought. Whereas what's showing up on our P&L is just the depreciation of that fixed asset, right? Does that make sense? Jenny? You get that?
I'm just still trying to understand how it fits in with all the expenses to answer the question. Because I see what you gave with the arbitrary useful lifetime of 5 years.
Uh-huh.
I think I'm still a little confused about the year 4 and year 5 and the difference in between to understand that and to apply it to the question.
Well, so what they're asking in this question, just to be really clear, is they're asking you, let's say that you didn't have all this. Okay, we'll just take that away for a second, right? Now it's asking you, when you look at this P&L and you see the amount of $367,000, is that 367, does that represent the purchase of a fixed asset? That's what it's asking you. It's that simple. Is that the purchase of a fixed asset?
Like, was that the amount of money to use to buy that?
Exactly. That's what it's asking you. Uh-huh.
Okay.
And so what do you think the answer to that is?
No.
No.
Right? It's no. And so your hint is, whenever you see the word depreciation, it's never going to be it's never going to be the money that you use to buy it. It's only the theoretical, the word depreciation, which just means the erosion, right, of the value of your fixed asset you already purchased.
Okay.
And it's usually only going to represent a small portion of it. And so you're not actually expending cash when you depreciate something, right? It's a theoretical erosion of the value of whatever you purchased in the past. So it's really important to know that, because you didn't expend $367,000 in this year. You already bought your asset, a few years ago. We don't know exactly when, but we know that you already bought it. So but the good news is you can report it as an expense on your P&L. The accounting, rules allow you to do. And by doing that, you actually are showing less income down here, right? You're showing less income, because if you didn't have that at all, right? If you didn't have it, you would be showing more income. The income went up to 1.6. So if you're a taxable entity, what does that mean if you're showing more income?
Okay.
You pay less taxes.
It means you have to pay more taxes, right? So the fact that we can expense our depreciation, that creates what they call as a tax shield. Right? That means we can avoid a certain amount of taxes because we depreciate our assets, right? And so that's what's important to understand here, is that it's something that the accounting rules have allowed us to do, but it's not really spending money. It's not actually expending cash. So the depreciation on your cash flow is always going to be something you deduct out. It's not really true cash, okay? It's more of you don't want to call it a fictitious, because it's not really fictitious, but it is a non-cash charge on your P&L. Okay. I know it's a little bit confusing. We have some more things we're going to get through in a minute, but okay. And then profit margin. So it's asking, what is the profit margin? So how do we calculate profit margin? Anybody want to give me that one?
Was it the total expenses divided by the revenue and then times 100 for the percentage?
Total profit.
Total expenses divided by the revenue.
No, not expenses. Profit margin is net income. So what it's saying is, how much income are you generating on your revenue that you bring in, right? That's what the profit margin is. How much profit or net income are you generating on the revenue that you bring in? So in this case, you have $1.2 million worth of net income. You had $28.6 million of revenue, right? So that means you're generating 4.3% profit on your revenue. Does that make sense?
Yes.
Okay, so let's look at the example over here. This is the previous example. I think it asks that as well, right? It asked it in a different one, but let's just go ahead and do that. So what's the profit margin on this business that we did in the first example? We have $30,000 worth of profit on $410,000 worth of revenue. So that's a profit of 7.3%, right? Whereas this one is 4.3%. But look at this. This becomes $1.2 million in revenue. It's a lot more. And this is $30,000 in revenue, right? So the profit's much better here in this business, but here you're making a lot more, right? Okay, let's keep moving because I know we've got our time's running out, and I do want to get through some of these. Let me ask a question first. Is there any particular problem that someone would like me to go to versus going through each one of these?
The last three questions.
2.
Sorry? I heard the last three, and then what was the other?
If we could start with 3.9, probably.
Yeah?
Please.
Okay. Okay, so this one, yeah, was one of the, I guess you'd say, hardest, right? Okay, so this one is about constructing the revenue section, right? Okay, yeah, so I remember this one now. Okay, so then what it's saying is you have a general ledger, okay, where you have all your detailed information about your patients and the charges for your patients and things like that, right? So your general ledger shows that you have patient services, that you have contractual discounts, right? You have charges for charity, and you have patient services revenue. So all of that shows up in your general ledger. Okay, everyone know what the general ledger is, right? It's the detailed books that the detailed accounts we keep for each patient, right? So you're going to see all that detail here, right? And you're going to have a bad debt estimation, and you're going to have then your net patient services, right? So then what is it, it says this in the book. I don't remember what page it is, but it's shared. If you're creating a profit and loss statement, okay, and it's it's really clear about what you can put on your profit and loss statement and what you can't. So I guess the question is, do you put your gross revenue, your gross patient services revenue that before all these discounts, or do you put your net number? Can someone clarify that? Anybody remember that piece in the book? Anyone want to take a stab at it?
We said no for the charges for charity.
Right. And what about the contractual discounts? Can anybody think of a reason why it wouldn't make sense to show contractual discounts on a profit and loss statement?
Because it's a loss?
So what it is when you negotiate with another organization and you negotiate a contractual discount, your what you're selling to them, right, is the amount you agree on in the contract. So let's say you have a published rate of $100 for something, but you negotiate with a company for $50 for that same thing. So you're giving them a discount of $50. And hopefully that discount comes along with a high volume, because that's really usually what you do. But if you're contractually obligated to pay them $50, does that make sense then for you to show on your profit statement $100 for the sale, even though you've already negotiated $50 for that with that particular contract?
No.
It doesn't make sense, right? Because you've negotiated a lower rate. So you might have a published rate that shows $100 for that item, right? But you've negotiated 50 already. So you can't show $100 on your P&L. You only can show what you negotiated contractually, right? And that's what that means is you might, in your general ledger, you might be showing your published rate on your charge master, right? You might be showing that $100 rate, but the net amount that you've negotiated is where the contract discount comes into play. So you can only show on your P&L the amount that you're contracted by, to sell goods, the contracted rate. And that's why it's really important that you show this number as a net, like a net number. It has to be net of all the contracted discounts, okay? Because that's what you're legally obligated to charge. So just remember, when something's contractual, it means you're legally obligated to charge that rate. And so therefore, you should always be using contracted rates when you show a P&L. Even though your general ledger might have a published rate, that's because you want to keep track of how many discounts you give people, right? But that's not something you're going to show on your P&L. And the same with charity. If you've already made an agreement to provide a discount or not collect revenue for certain cases, certain indigent cases, that means you're essentially setting a new price for those type of patients, and you need to show on your P&L what that price is, not the higher price. Okay, because what you don't want to do is inflate your revenue. If you've already made the decisions to commit to lower pricing for indigents and for other contracts, and you have to show that pricing as your profit, as your revenue, excuse me. So your first thing you're going to show really then is, in fact, your 625 is what you're going to show. You're going to show the 625 as your starting point, okay? And then you're going to, go ahead and add your provision for bad debt, because we've talked about that before. You still would show that, and then you've got your net number, right? Okay. Does that make sense to everybody? Anybody have a question about that? Okay. All right. Okay. And then, the expenses are, I don't think there's a whole lot of confusion about that, right? The expenses, let's see, what did I do here? I think I might have given an example. Oh, that's right. I just put a fictitious number in here. They don't actually speak to expenses in the example, okay? And therefore they don't speak to net income. But what I wanted to do is put some number in here so we could do the next problem. I think they did say that there's a provision for income taxes of 40%, right? So what the next question in this problem was, okay. So let's assume that you found out that your numbers were understated. Understated or overstated. Sorry, what did you say? Understated by 50,000. Okay. So then what we would do is we would say, okay, well, this number, the patient, let's see again, it was your allowances, okay? Your contractual discounts and allowances was understated. So that means then that actually the corrected number would have been 300 here, right? You see that? So instead of 200, it's 300. So that means this number, right, your net number would be 575, okay, instead, right? So that means that you've got a difference here in your revenue of 50,000. It's 50,000 less, essentially, than you originally reported, okay? Now, it says that your provision for taxes is 40%. And so what's a little bit hard about this example is you don't actually have expenses. But as I said, I put expenses in just as a placeholder because the answer doesn't really matter as long as you're making a profit. It doesn't really matter, but I think it's just easier conceptually to see it. So let's say that in your first example, you had a profit or a net income of $325,000, right? And you had 40% provision for taxes, okay? So that would have been taxes of $130,000. Does everybody understand what I just did there? Anybody not understand? Okay. So then what I did here is I changed the revenue, okay? And I left the expenses exactly the same because they would be the same. They wouldn't change. And then my net income changed, right? It changed by 50,000. So therefore my taxes, right? I'm going to recalculate my taxes now. And my taxes are going to be lower by 20,000. Okay. So what's interesting about this, it really doesn't matter what my expenses are. I could make my expenses $100,000. Sorry, excuse me. You know, and it wouldn't change the income because, you know, you're using two examples and you're comparing them. And so as long as you have the exact same expenses in both examples, it's not going to make a difference. The only change that you're showing is the income. And so what I'm trying to show is that you could just calculate the tax impact on the income change only, and it would be okay to do it that way. So if you say we've got a change of $50,000 in your revenue, it's changing by $50,000. We know we made a mistake. We're correcting that mistake. It's a $50,000 mistake. So what you're saying is I paid taxes on $50,000 that I shouldn't have paid taxes on. So I'm going to calculate what that change would be, is I'm going to say the 50,000, and I'm going to use the $40,000 worth. The 40% of the tax rate calculated on the $50,000 change. So I'm taking the $50,000 times the $40,000 of taxes, and it's $20,000. So you can do it in a couple ways. You can do it by comparing the first scenario to the second scenario and then figuring out what the change is, which is what we did here. Or you can just take 40% on the difference in revenue, and it's going to be the same answer. Okay, and I know this one is negative, but I'm going to make it positive, okay, so we don't get too confused. But we paid 90. We should have paid 170, right? So we get a savings. We get a savings by of 20,000 is what this says. Okay. So the answer then is you're saving $20,000 by changing your revenue, okay, or reducing your revenue. Does everybody get that? I can't read you guys. Okay, let's see. Then it asks about the differences in the net patient services revenue, right? So we talked about that. There's a $50,000 difference. We talked about the expense, right? And then we said there's no change on expense. Changing revenue is not changing expense in this example. We're just restating. There's no change in expense. No impact. And then net income is going to be the exact same impact as the revenue, right? It's $40,000. Okay. And then lastly, I think it asked about, yeah, I think that was it. Okay. Any other questions on this one? Let me go and see then. I think 3.8. This one's a good one. Let's just quickly do this one if we can, okay? So this is a little tricky. This one is 3.8, the skilled nursing, because it basically shows construction costs of 10 million, land of 8 million, facilities cost of 18 million, salvage value of 1.5. Okay. Now, what's tricky about this one is you have to look at the book, and the book really clearly tells you that you can't depreciate land. Okay. So land is not depreciable. It means it doesn't erode. There's only most assets erode, but not land, right? You can't. So when you do your depreciation calculation, you can't add the land into that. You have to subtract it. Okay. And then I think somebody had pointed out earlier, we have to also, if we know there's a salvage value on our construction, we have to subtract that as well from our a depreciation base. So when we look at our depreciable asset, we're subtracting, right, the construction cost from the salvage value. That's where we start with our depreciation. Does everyone get that?
Could you further explain that again? I'm sorry.
Okay, yeah. So when you're looking at a facility cost, and part of it is land, the land is not depreciable. So you're trying to calculate what your depreciable base is so that you can figure out what to put on your profit and loss statement in terms of depreciation. So you have to look and you have to say land is not something that depreciates over time. So you're not going to include land in your calculation for depreciation. You're only going to include the construction costs. Now we happen to know in this example in the book, it says that the salvage value is 1.5 million. And we talked about that before. Salvage value, you can deduct the salvage value from your depreciable base. So when you're calculating your basis for depreciation, you can take your construction cost less your salvage value. And that gives you your amount that you're going to depreciate, which is 8.5 million in this example. Your useful life is 20 years, so you're going to divide the 8.5 million by 20 years to come up with your annual depreciation. In this case, it's 425,000. Okay? Does everyone understand that?
Got it.
You got it? Okay. And then we know our tax rate's 40%, right? So then what you have to calculate is our depreciation times our tax rate, and that is $170,000. So that would be what we can put in our financial statements. We can put $425,000 into our financial statement as expense, and therefore it's putting in more expense, less income. So what we have to pay taxes on less income, and that impact would be $170,000. Okay, that's what we save. We save $170,000. Okay, does that make sense?
Yes.
Okay, let me just check and see what the actual question is. Make sure that I did answer that appropriately, because it says, assuming a 40% income tax rate, how much did Bright Horizons save in income taxes, right? So that's how much they saved. They saved $170,000. Okay. All right. Okay. Did everyone understand the statement of changes in equity pretty clearly? Was that clear on how to do that one? I think if you followed the book example, it should be pretty easy. Any questions on this one? Okay. And then this one was, let's see, I'm trying to remember this one now. Oh, this was about cash flow. And I think there was a couple problems on this one, or confusion maybe on this one. So you had to make some assumptions on this one, right? Because it wasn't, not all the information was here. But basically, you had your revenue, and I think you were trying to compare your P&L with your cash flow statement is what they were asking, right? So you had to build your P&L, the 12 million, you had to come up with your other expenses, right? So it said that your other expenses reflected 75% of your revenue. And then your depreciation was 1.5 million. So your total expenses then would have been 10.5 million. Your operating income then was 1.5, which was subtracting your total expenses from your revenue. Your provision for taxes now. So it said that it was 40%. Okay, 40%. So you would multiply your net income or your operating profit by 40% to come up with your provision for taxes. So your net income then would have been, less taxes, right? Less your provision for taxes. Okay, and then what it was asking is how does that look for your cash flow? And it said basically that your revenue is all collected in the same year, so that your inflows, your cash inflows should equal your revenue. So that's, you're doing sort of a similar to a profit and loss statement, but it's a cash flow. You're going to pay all your expenses out. Now remember, depreciation is non-cash, right? It's a charge from your balance sheet, but it's not, you don't have to actually pay any cash for it. So when you're doing your cash flow, you need to take your depreciation out. So essentially then you've got the 12 million in revenue or inflow, 9 million in outflow, and then you have your taxes, right, that you have to pay. That's an outflow. So then what's your net cash? It's going to be inflow less all expenses except depreciation and your taxes. And that's what your net number should be. Okay.
Everett has a question.
Okay.
Yeah, it's being recorded. Sorry.
I can see it. I'm not seeing, because I'm on my Excel, I can't see the question. So let me go back to,
The question is, and Mena answered it.
oh, okay.
It was about if it's being recorded.
Oh, okay. Okay. All right. And then this one was the Brandywine Homes. Again, we had some cash flow questions, but I think the previous one may have answered that one. Okay. I know we're out of time now. So do you guys want to, I think we will just go ahead and stop here. And hopefully this was helpful.
Yes, it was. Thank you.
Okay, good. Great. Feel free to email me though if you've continue, have questions and stuff. Okay.
Okay.
I think going through the book another time might be helpful for all of you guys as well, and then we can potentially debrief on some of these problems afterwards. All right.
Okay. Can we also explore just like maybe you recording lectures, like without Zoom, just you going through real life examples of things that the book brings up?
Yeah, we can definitely talk about that, but I'm not sure I understand exactly what you mean. Maybe can you clarify a little bit? Like give me an example of what would be helpful.
Like, so each chapter, just you recording a lecture on the chapter, summarizing key points without like Zoom and this would be in addition to office hours.
Mm-hmm. Well, why don't we, you and I can talk about that so I can understand a little bit more about what you need, because it's still not, I'm not sure I completely understand what you're asking for. But why don't we take it offline? Let me hear what you have to say about it, and maybe I can think about it. Okay?
Okay.
All right. Thanks, everybody. Appreciate your time.
Thank you.
Okay. Bye-bye.
Bye.